I'm Yaneli, also known as Miss Be Helpful, with another FinCap Friday brought to you by NGPF. Getting started investing in the stock market can sound a little intimidating, but data shows that a significant portion of new investors are not letting that stop them. About 20% of new investors are between the ages of 18 and 36. This means that younger and younger people are now investing compared to just a decade ago. But there's one super important rule that all current and future investors need to know about: capital gains taxes. Capital gains tax is a special type of tax that you have to pay on money that you've made in profits from selling certain assets like stocks, bonds, ETFs, or real estate. This tax rule gets activated anytime you sell an asset at a higher price than what you paid for it. But the thing is, the actual tax bill does not get generated until tax season comes around. That's when you need to report your profits to the government, specifically the Internal Revenue Service or the IRS, by filing your taxes. So that means there's a gap of time between when you might take profits out of your investment account and when you have to actually pay the capital gains taxes you owe on those profits to the IRS. This can hurt new investors because a lot of times they either don't know about these tax rules or they did not set aside any money so that way they can make sure it's sitting there when the IRS comes to collect it. This is where a little psychology comes in. You might think, well, if the money's just going to be sitting in an account for a few months waiting for the IRS to come collect it, maybe I could just use it now and then I'll worry about the tax bill from the IRS later when it actually arrives. That's a classic investing mistake that leads to unexpected and scary tax bills. But what if you're a complete newbie to the stock market and you never knew anything about this capital gains tax stuff? Well, in that case, you will have a financial problem that you'll need to solve because the IRS generally does not make exceptions for new investors or any investors who have to pay capital gains tax that they owe. Tax deadlines and capital gains tax rules apply equally to all taxpayers regardless of their investing experience. So if you've collected profits from the sale of stocks in an investment account that doesn't come with any tax advantages like a retirement plan would or a college savings plan would, then you're going to be 100% responsible for paying the capital gains taxes that you'd owe on any profits that you took. But there's some good news here. If you hold your investments for more than a year, then you can significantly lower your capital gains tax bill. This is because there's two types of capital gains taxes: short-term capital gains taxes, which apply when you sell investments that you've held onto for less than 1 year, and long-term capital gains taxes, which apply to you when you hold onto investments for more than 1 year before selling them. And this stuff is serious because if you don't pay your capital gains taxes that you owe by the tax deadline, then the IRS will charge you penalty fees and interest fees on top of your unpaid amount. So this is only going to further increase the total amount of debt you owe to the government. If you ever find yourself in a situation where you have to pay capital gains taxes, but you don't have the cash on hand, then you can apply for an IRS installment agreement or a payment plan. The IRS does offer different types of payment plans depending on the amount that you owe, but they also charge setup fees for most of these plans, ranging from $30 up to $225 depending on the payment method that you use. So the quick lesson here is educate yourself first on taxes and other investment rules before you begin to trade stocks or buy any real estate. Learn about the full responsibilities that come with investing and then start investing. And don't forget to proactively plan ahead for taxes by setting aside 20% of any profits that you take out of your investment accounts, because sooner or later you will have to pay capital gains taxes to the IRS.